It can feel like you're in a toxic brew when trying to navigate through a market environment characterized by waning sentiment and persistent inflation. Investors could interpret this situation as stagflation and a scenario where everyone reaches the nearest fire exit. As we approach US inflation metrics that are becoming more visible, we are experiencing a significant worry. What role do geopolitical tensions play in shaping oil prices and market sentiment? Hello everyone! Welcome to our deep dive into the financial world, where we decode the mysteries of the markets using ancient Eastern wisdom. Today, we're unveiling how the Yi-Jing, Book of Changes, and the Art of War can illuminate the current financial labyrinth. If you're curious about how ancient strategies can guide modern markets, this video is for you. In the grand theatre of the financial markets, we're witnessing a peculiar ballet. The duet of waning sentiment and stubborn inflation, performing a choreography that could make even the most stoic investor sweat. Here, in the glow of the financial footlights, we find ourselves at a crossroads that whispers of stagflation, with every investor eyeing the exits, ready to sprint. As the curtain rises, we see a stage set by a backdrop of economic data that's as comforting as a lullaby sung by a rock band, jarring, loud and slightly off-key. Stagflation is a bit like a diet where you eat less and still gain weight, economically speaking. It's a paradoxical situation where the growth of the economy slows down, but prices keep climbing up, as if they're on a never-ending escalator. In today's economic climate, understanding stagflation is crucial because it affects everything from consumer purchasing power to investment returns. The implications are severe. Businesses may see reduced consumer spending, while investors find fewer safe havens for their capital. Additionally, traditional economic tools, such as lowering interest rates, might not be as effective in combating stagflation, as they can further fuel inflation without necessarily stimulating growth. By connecting these concepts with current economic trends, it becomes clear why today's investors and policymakers are on high alert. The current signs of stagflation are not just theoretical concerns, but real challenges impacting global financial markets. Xian has been interpreted over centuries as a guiding principle for leaders to follow a path of insightful influence and strategic foresight, often associated with the ability to foresee and act upon the undercurrents before they surface as tangible events. In the context of the Yi-Jing, Xian symbolizes the interconnectedness of actions and their deeper impacts. This can be likened to the butterfly effect in chaos theory, where a small change can lead to significant, unpredictable outcomes. In modern times, Xian is often seen as a metaphor for the underlying forces in economics and politics, forces that shape the world in ways that are subtle yet powerful, much like market sentiments that drive economic cycles beneath the visible surface of stock movements. The concept of Xian can be particularly relevant in understanding how underlying sentiments and economic indicators interact to produce phenomena like stagflation, where slow economic growth coincides with rising inflation, often reflecting deeper, unseen economic forces at play. In today's economic environment, understanding the hidden sentiments and underlying forces can help predict and manage periods of stagflation, much like navigating a ship based on the undercurrents rather than just the winds. The volatility of oil prices, often influenced by geopolitical tensions, can be seen through the lens of Xian, where the deeper currents of political moves and negotiations impact market prices in ways that are not immediately obvious. Applying the principles of Xian in economic strategy involves using a deep understanding of the market's underlying forces to guide decision-making, akin to a chess player thinking several moves ahead. Inflation is the villain that eats away at your purchasing power. For investors, it's akin to watching a horror movie where your dollar bills shrink right before your eyes, forcing you to rethink where you park your funds. When inflation rises, the real returns on investments can diminish, making it harder to achieve financial goals. For instance, if inflation is at 5% and your investment returns are at 6%, your real return is just 1%. This scenario forces investors to seek higher returns, which typically come with higher risks. Consequently, portfolios might need rebalancing towards assets that historically perform well during inflationary periods, such as commodities or real estate. Strategies to mitigate these risks include investing in inflation-protected securities, diversifying across asset classes, and maintaining a flexible investment approach to adjust as market conditions change. The dance of oil prices and geopolitical stability is a complex ballet, performed on the world stage, where every act and actor plays a critical role. Currently, the oil markets are especially sensitive to global political shifts, with every rumor of war, peace, or economic sanction causing ripples that reach consumers worldwide. This relationship between global politics and oil market dynamics is highlighted by recent events. For example, the uncertainty around ceasefire talks in the Middle East has led to significant volatility in oil prices. These fluctuations affect not just the oil markets, but also the broader economic landscape, impacting everything from the cost of manufacturing to the price at the pump. Understanding these dynamics is crucial for investors and policymakers as they attempt to navigate the choppy waters of international relations and energy economics. The ceasefire talks, or the lack thereof, between Israel and Hamas are like a suspense thriller impacting oil prices with every twist and turn of the plot. The ongoing conflict and the uncertainty surrounding ceasefire agreements have created a volatile environment for oil markets, causing prices to fluctuate based on the latest news. This volatility is a significant concern for economies and businesses worldwide, as oil prices influence everything from transportation costs to the cost of goods. The uncertainty makes it challenging for businesses to plan for the future, and for countries that rely heavily on oil revenue, it can lead to significant economic instability. Investors and market analysts closely watch these developments, understanding that until a stable agreement is reached, the oil markets are likely to remain unpredictable, impacting global financial stability. When US crude oil stock piles up, it's like a clearance sale where no one showed up, indicating weak demand. This scenario often leads to a drop in oil prices as suppliers attempt to balance stock levels with market demand. Conversely, when demand outstrips supply, as it often does during peak travel seasons or amid geopolitical tensions that threaten supply lines, prices can soar. Saudi Arabia's recent decision to raise oil prices reflects an anticipation of strong demand over the summer months. This strategic move is aimed at balancing the market and ensuring that the kingdom maximizes its revenue from oil exports. These dynamics between oil stock levels and demand fluctuations are crucial for investors and policymakers. They provide insights into the health of the global economy and potential shifts in energy policy and economic planning. There was a time when bad news was the market's guilty pleasure because it meant more stimulus treats. Now, not so much. If inflation numbers startle the market, the switch flips to bad news is just bad. This shift reflects a deeper change in market psychology, where the anticipation of continuous support from monetary authorities is no longer a given. Investors are now more vigilant, reacting quickly to any signs that might indicate a tightening of monetary policy or an increase in inflationary pressures. This heightened sensitivity can lead to increased market volatility as investors rush to adjust their portfolios in response to new data. Understanding these reactions is crucial for anyone engaged in the financial markets, whether they are day traders or long-term investors, as it helps in making informed decisions that align with broader market trends. The only thing dropping faster than oil prices on some days is the audience's interest in a magician whose only trick is pulling a rabbit out of a hat. Again, ceasefire talks and global strategic reserves can sometimes press down prices faster than you can say, "Drill, baby, drill." On the flip side, when Saudi Arabia decides to hike prices, it's like someone decided to turn the heat up at our aforementioned overheated party. Strong summer demand forecasts are keeping the hope of high prices alive, much like a beach vendor selling ice cream on a scorcher. Investing during stagflation is like trying to salsa dance in quicksand. The key? Move your feet carefully, diversify your investments, and maybe, just maybe, keep an eye out for those rare opportunities that glitter more than a disco ball in moonlight. Geopolitical drama doesn't just fill news cycles, it stirs market sentiment too. Whether it's saber-rattling in the Middle East or trade tiffs elsewhere, the market reacts as nervously as a long-tailed cat in a room full of rocking chairs. These tensions can lead to significant market fluctuations as investors respond to potential threats to global stability and economic growth. Recent increases in geopolitical tensions have been particularly impactful, causing shifts in market sentiment that are swift and sometimes severe. For instance, the escalation in the Middle East has led to concerns about oil supply disruptions, which in turn have influenced global oil prices and stock markets. Navigating these turbulent waters requires a keen understanding of both global politics and market dynamics. Investors who can anticipate or quickly react to changes in geopolitical climate may be better positioned to manage their portfolios effectively. Investing in times of economic uncertainty is like trying to change tires on a moving car. It's tricky, but not impossible if you know which tools to use and when to pull over. As we navigate through the murky waters of stagflation and geopolitical instability, strategic adjustments to investment portfolios are essential. Investors should consider diversifying their investments to reduce risk. This might include adding commodities, real estate, or inflation-protected securities to a portfolio predominantly made up of stocks and bonds. Additionally, staying informed about global economic indicators and geopolitical events can provide critical insights that help in making timely investment decisions. Practical investment advice during these times would include maintaining a balance between defensive assets, like gold and bonds, and growth-oriented investments, to hedge against both inflation and economic downturns. Predictive analytics in investment is like weather forecasting. It doesn't always get it right, but it's better than sticking your head out the window to see if it's raining. The use of sophisticated algorithms and models to predict market movements has become a crucial tool for investors looking to gain an edge. However, these tools are not infallible. The art of prediction also involves understanding human behavior, market sentiment, and the broader economic context, which can sometimes defy logical patterns. For instance, despite negative economic indicators, markets might rally on a surge of optimistic sentiment or unexpected policy announcements. Investors who combine analytical tools with a deep understanding of market psychology may improve their chances of success. But it's important to remember that in the world of investment there are no guarantees, only educated guesses. Markets, much like people, can overreact or underreact. Understanding these patterns is like having a roadmap through the fog of investor psychology. Behavioral economics provides insights into why markets might not always behave rationally and how emotions can drive investor decisions. Common psychological traps include herd behavior, where investors follow the crowd without sufficiently assessing the underlying value, and confirmation bias, where they seek information that confirms their preconceived notions. Being aware of these biases can help investors make more rational decisions, especially in times of market stress. Applying behavioral economics in investment strategies involves looking beyond the numbers to understand the human elements that drive market movements. This approach can lead to more balanced and thoughtful investment decisions, reducing the risk of making panic-driven or overly optimistic trades. In the face of economic stagnation and high inflation, certain sectors may prove more resilient than others. For instance, utilities and healthcare tend to be less sensitive to economic downturns because they provide essential services that remain in demand, regardless of the economic climate. Investors might consider increasing their exposure to these sectors as a defensive strategy against stagflation. Additionally, investing in commodities like gold, which often performs well during times of high inflation, can provide a hedge against the eroding value of currency. Another practical tip is to focus on companies with strong balance sheets, low debt levels, and consistent cash flow. These characteristics can help businesses withstand economic headwinds better than those with weaker financials. Diversification is your investment portfolio's life jacket in the choppy waters of stagflation. Don't put all your eggs in one basket, especially if that basket is inflating faster than a hot air balloon. By spreading investments across different asset classes, sectors, and geographical regions, you can mitigate the risk of significant losses if one area of the market performs poorly. Effective diversification strategies involve more than just mixing stocks and bonds. Consider incorporating real estate, commodities, and potentially alternative investments like hedge funds or private equity, which may behave differently from traditional stocks and bonds under various economic conditions. Regularly reviewing and adjusting the diversification strategy based on changing market conditions and personal financial goals is also crucial. Long-term planning in today's market is like planting trees under whose shade you do not expect to sit. It's about setting sights beyond the current turmoil. In volatile markets, it's easy to get caught up in the day-to-day fluctuations and make reactive decisions. However, maintaining a long-term perspective can provide stability and clarity, allowing investors to focus on their ultimate financial goals rather than short-term gains or losses. Investing with a long-term horizon typically involves looking for investments that offer sustainable growth, despite short-term market volatility. This might include stocks in well-established companies known for steady growth, or sectors poised for long-term expansion like technology or renewable energy. By staying invested over the long term, investors can also benefit from the power of compounding, where gains on an investment generate their own gains in the future. This can significantly impact the growth of an investment portfolio over time. Studying past economic cycles is like time traveling without a DeLorean. It offers valuable insights into what strategies worked, what didn't, and why. For example, during the stagflation of the 1970s, investments in commodities and real assets like gold and real estate performed well as inflation soared. Similarly, during the dot-com bubble, those who recognized the unsustainable growth in tech valuations managed to avoid significant losses by diversifying or exiting those positions early. Learning from these historical cycles can help investors identify patterns that might indicate the onset of certain economic conditions, such as inflationary pressures or market bubbles, allowing them to adjust their strategies accordingly. Every economic cycle teaches us something new about handling our finances. Learning from past mistakes is the key to not repeating them. One common mistake is the failure to adjust investment strategies in response to changing economic indicators. For instance, clinging to high-growth tech stocks without acknowledging overvaluations can lead to significant losses when market sentiment shifts. Another lesson is the importance of liquidity in a portfolio. During financial crises, having access to liquid assets can be crucial for taking advantage of market downturns to buy undervalued assets, or for meeting financial obligations without having to sell investments at a loss. By incorporating these lessons into their investment strategies, investors can better protect themselves against future economic downturns and capitalize on potential opportunities that arise during these periods. Forecasting the future here is like trying to predict the plot twists in a telenovela. However, if the past is any guide, we should buckle up for more inflation drama and maybe, just maybe, a light at the end of the tunnel if those geopolitical clouds start to clear. While precise predictions are challenging, trends suggest that inflation may remain a significant concern in the near term. This could continue to impact consumer spending, investment returns, and economic growth. However, proactive monetary policies and international cooperation could help mitigate some of these effects. If current tensions were a weather system, they'd be a hurricane named uncertainty. Watching how nations play their cards in the coming months will be crucial for predicting whether we should expect smooth sailing or batten down the hatches. The ongoing geopolitical risks, particularly in the Middle East, and in trade relations between major economies will likely continue to influence the global economic landscape. Investors and policymakers will need to remain vigilant and adaptable to navigate these challenges effectively. In conclusion, navigating the storm of stagflation and turbulence in the oil markets requires a blend of historical insight, strategic foresight, and a steady hand at the helm. To put it simply, we have witnessed that it is not only feasible to combine ancient Eastern wisdom with modern financial strategies, but it is also possible. This is a revolutionary invention. From embracing change to finding a balance between empathy and determination. This perspective on business management is refreshing thanks to these principles. Therefore, let's stay optimistic. These timeless and timely strategies can help businesses thrive. The importance of balance and smart strategy cannot be overstated. The key is to find the perfect spot and maintain agility, just like a tightrope walker with a safety net. To navigate the future economy, it is crucial to adopt careful and smart strategies that emphasize balance and adaptability. The current global market situation is not a simple matter. It has both favorable and unfavorable factors, as well as opportunities and risks. The environmental resources of each region on Earth are unique due to their differing latitudes and longitudes. We can summarize real-time opinions using artificial intelligence operations, such as neural networks that take into account regional characteristics and national economic data. By watching our videos every week, you can keep yourself informed with a wealth of information that will improve the quality of your life in many ways with minimal time investment. In order to survive in these volatile financial environments, it is crucial to be able to adjust and avoid increased risk. Regardless of how experienced you are in investing, it's crucial to keep an eye on our video debuts to make better decisions. It's crucial to remember that knowledge is not just a tool to enhance your value, it's also a power. If you have any topics you're interested in, feel free to leave a message. To conclude this episode, I want to express my gratitude to all the viewers for their support. If you find that today's video is helpful, please like it, so that you can easily find it later when you need to watch it. I want to express my gratitude for your attention. Thank you.